And there has also been a debate about introducing a small change to the forward guidance that is removing a clause that says that you are still ready to lower rates if needed. And if I'm not mistaken, this clause is still in place. So could you explain to us why and if there has been a debate on this passage? Thank you.
And the third block was a discussion about risks, about the economic situation, how it has evolved. And again, there was a general recognition that the balance of risks has improved, certainly as far as growth is concerned. So, following from this, it's quite clear that the assessment of certain scenarios that were considered very likely before is now telling us that these scenarios are going to become less likely. And that had some consequences in our language, namely, there was a sentence which has been removed from my introductory statement that used to say, if warranted to achieve its objective, the Governing Council will act by using all the instruments available within its mandate. You remember from the previous introductory statement, that's being removed. That's being removed because basically to signal that there is no longer that sense of urgency in taking further actions while maintaining the accommodative monetary policy stance, including the forward guidance, but that urgency that was prompted by the risks of deflation isn't there. That was the judgment, the assessment of the Governing Council. The second issue on which I would like to draw your attention is that, as you know, the last TLTRO, the TLTRO's list is going to expire, and there was no discussion about having another TLTRO, not at all. Then we had not an intense, but just a cursory discussion about whether to remove the word lower from the forward guidance.
Okay guys, so coming into this March meeting, look back at January, policy unchanged, 60 billion until December 2017, rates also unchanged. This was totally expected and is what is expected today. Remember, we're only 2 meetings post the ECB taper from December 2016, so not a great deal expected in terms of policy change. In terms of language from the previous meeting, maintained the usual comments around rates, that they would remain at their present or lower levels for an extended period of time. Asset purchases would run until December 2017 or beyond if necessary. Inflation remains subdued. That's a crucial thing. The ECB has continued to term inflation as subdued. So any kind of change there could be very significant. In terms of the asset purchase programme, contingency wise, all available instruments in its mandate was left in, as well as the ECB could adjust size and or duration of asset purchases should they not meet their inflation goal. So that's the situation there from the previous meeting. In terms of expectations for this meeting, nothing on rates, on stimulus or language. Then we come down to the staff economic projections. The big one here, or the big change here, is the CPI projection. 2017, the forecasts from economists is a big jump from the ECB 2016 forecast, so jumped to 1.8% from 1.3%. Further out, 2018-19, unchanged. GDP, a slightly smaller increase, 1.7 to 1.8. And again, further out, unchanged. So the big thing, the big focus is on the CPI number. And this is perhaps why, in terms of movement coming into this, we have seen yields rising. Yields are now at their highest levels of the year. So you've got to think to yourself, what is there that the ECB can do that is going to continue this increasing yield levels? it's going to have to be pretty hawkish, and it's going to have to sort of change the situation a little bit to really continue these moves. In terms of sources, we've had no sources, which is uncommon from the ECB. And one final thing is TLTROs are ending. So what's happened in the past, the ECB has continued TLTROs once they've ended. So that again could be an area of questioning for Mario Draghi. Now in terms of statement, and this is where we're looking at potential areas to change, we could see any kind of change to language regarding rates or the asset purchases. That present or lower phrase which comes in regarding rates, it's unlikely that this will change because this affects the ECB sequencing, which means that they have always said that they would keep rates at present or lower levels beyond the asset purchases. So that's probably the area that is least likely to change, at least initially. Asset purchases, size and or duration is another term that they use for the continued use of the asset purchases. Any shift from December 2017 or beyond, so they could drop the phrase or beyond on their asset purchases. This would be a very hard taper. Basically it's saying that there will be no more buying after December 2017. That would be a major outlier and create a very large move, or you would expect so. Any change in the inflation outlook could cause a bit of a move. Again, this is the ECB becoming a little bit more hawkish. And then finally, any shift in the all available instruments. Now, we're coming into this, remember, in the Q&A. So you would have already read the statement. So hopefully if any of these things have changed, you will have picked it up already going into the Q&A. So let's go and have a look at some chart levels, or just take them down. You've seen the charts. What we're looking at, 63 to 65, bottom of that previous range, and then beyond there you're then looking to 81s and that trend at 84s. 99, small level above there before 161, 17s. Now to the downside, because we are at highs of the year in terms of yield, we're also at lows of the year in terms of price. So not a great deal lower, but we do have some older volume references. So you've got 36, 34, sort of small area that's been holding during the beginning of the press conference. 22, the low of the day, and then you've got those volume references down at, I've got it down on the chart at 97, but it's double O's to 95s really, 87s, and then a little LVN down at 80s. So in terms of trades, 12:45, of course, you're going to be looking at any kind of change in rates and asset purchases. Nothing comes out, then you'd expect no change on the unchanged. And again, if this is the case in the statement, all unchanged, then still no real trade. You could see a little bit of movement and you might see a little bit more energy in the market, but no real directional trade. In terms of inflation, any kind of shift away from subdued, so perhaps inflation is no longer subdued, could be a phrase that they'd use. If you saw that, then that is likely to be a bit of a hawkish continuation trade, whereby you're looking to sell the Bund and then looking for ways to stay in that trade. Perhaps on a pullback you can add, or you can add on a pullback for a passive entry, but looking for continuation there. That would be a pretty major shift from the ECB. Now, in terms of dropping any language regarding the asset purchases, this is one where you would expect a bit of a sell and for a break of the low and continuation. Now, which area they drop is going to influence it more or less, so that the severity of the drop is likely to be influenced by what changes. Two areas that are really going to change, any change in the size and or duration, or the or beyond reference, that would basically imply that asset purchases are over, and that I think is going to be, they're going to be the two biggest ones. All available instruments could be quite big, and then also the dropping of lower. So all available instruments and lower, perhaps the slightly lesser of the big changes, but still it is nonetheless going to cause some kind of movement, or should do at least. And then finally, any discussion of dropping the language. So this is where Draghi could be questioned. Have you discussed changing any language? So watch out for this in questioning. Has he discussed anything? And also, have they actually dropped anything as well? Hopefully you will have sussed out whether they have or they have not dropped something from reading through those statements earlier on. Now, just to give you a little sense of where we are, this is what the market's looking like coming into the Q&A. We've had the 12.45 move just here. So this is on unchanged in rates, asset purchases, and you get a small skip up of 20 ticks in the bund. After that, you then get a quiet period until the beginning of the press conference, and not a great deal happening. Yes, volumes ticked up, middle of the press conference, it's been a little bit of activity, but the market has not really started to move, despite some of the things that Mario Draghi has already said in the statement. So it's down to the Q&A now, and that's where you're going to be coming in. So take a little note of where we are. 60s could be a little bit of a trigger point for a move higher. And then also you're looking towards these 36s and 30s if we are going to get a move lower. And that could be what triggers a move towards the lows of the day down at 22s. So that's the situation. It's now your chance to trade that press conference. Listen to what Draghi says in his answers. And then you can trade off that. All right, guys, best of luck.
And there has also been a debate about introducing a small change to the forward guidance that is removing a clause that says that you are still ready to lower rates if needed. And if I'm not mistaken, this clause is still in place. So could you explain to us why and if there has been a debate on this passage? Thank you.
So, hopefully by trading those sources, you prepped yourself a little bit and certainly become accustomed to how the bund moves on some of these events. So we're now going to move on to a drill. We're going to be looking at an ECB press conference and specifically at the questioning. So as I mentioned before, this is where Mario Draghi can use the questions to inform the markets of something, add a little bit of information perhaps the market hasn't yet picked up on. So in terms of your charts, so make notes of these levels or keep the chart, save the chart picture. What we've seen in the bund is quite a clear downtrend coming into this ECB meeting. So reasonably hawkish situation, certainly in terms of pricing for the bunds. We dropped below recent lows around 160.63 and are currently failing to get back above. So again, showing that there is still a little bit of weakness in the bund. Now in terms of levels and areas that you want to be looking for, we've got a clear downtrend which comes in at 160.84.
Namely the bund, which at this point,
and that comes in if we can get back above those 63. So if we get above 160.63, move up to 84 is on. Beyond there, you're then looking towards 160.99 is a small level, and then really 161.17 is the sort of key pivot area that I think the bund could target on a move higher. Move to the downside. Very low on levels to the downside because the fact this has not been traded for some time. So you're going to have to be looking at volume references.
Okay. So
now in terms of volume references, what I'm looking for is peaks of volume and dips in volume. So you can see that the most recent low has been made on a dip in volume. So that's why we've got that drop down and then bounce from that area. Beyond there, you're then looking at the next references, the next peaks and troughs in volume. So you've got 160, 159.97, 159.87, and then 159.80. They're the areas that you want to be looking for to the downside. So we'll go through the questioning. I'll explain the preparation as we have done in previous drills. So you've got a format, you know exactly what you're looking out for, and then you can trade that drill. So onwards, and I'll explain the drill.
Much like the euro rose, up towards those 171.
Before you start the drill, a little bit of reading for you. And again, this gets you into the practice of reading through previous statements coming into any kind of central bank meeting. It's a very important thing to go through, to watch how exactly they've been structured, and words or areas that could potentially change. So what I'd like you to do is read through the ECB statements from October, December 2016, and then January and March 2017. Take note in particular of the paragraph just before, let me now explain our assessment in greater detail, starting with the economic analysis. That's the first line of a paragraph within the statement. Take note particularly of the paragraph just before that. Look out for any changes in the wording, anything that's different as those statements progress. And this will then help you out, this is a little bit of a clue, will then help you out with the drill. So once you've done your reading, get used to how you can read through those ECB statements. It's now a case of watch the question, so click on that link there, just watch the question from one of the reporters, and then for the replay you want to set your replay for the 9th of March starting at 13:50 and 45 seconds. You're going to be trading Bund, so FGBL M7, so M for June contract. We just rolled into the June contract at the time, and trade this for 10 minutes. Start the attached video, so Draghi's answer to the question, at 13:51 and 15 seconds. This way you will get the answer in real time with what you're seeing on the ladder, and you can then react to his answer. So listen closely to the different things that he talks about. I'll give a little preview, as always, in the video preparation as well, so you'll have an idea of what you're looking for, and then you can start looking at trades to be taken on that. Alright guys, best of luck with the drill. Take note in your mind and do your debrief afterwards as well of what exactly he said that created the move, where the move accelerated, and where your opportunities were to get in, and what gave you a chance to get out as well. Remember from the earlier preparation that we did when we looked at the ECB in 2012, that final flush out of volume, that final flush and final bit of speed can often be your clue to get out of the trade. Alright guys, best of luck with the video, and there'll be questions and a debrief coming up.
That provides you the move and gives you that exit down at 69s. But all of that, it was all about recognising the move into 95s. To start with, when you drop below 17s, you got the bounce away. And then the second time round, anyone who bought it, thinking that they got away with it, buying those 95s, are just adding to the shorts if you get inside that block. So that first bounce from 95 actually helps you out on the wider trade. It just means that anyone selling below 17s actually gets quite a hard time and can be sitting in a relatively nervous trade waiting for then the larger move to actually play out. But that was the main trade, and it was all about understanding that move into that block that provided you with that opportunity, and that's your structural completion trade. So make sure you're thinking about those situations when you go into any of these central banks, because they can provide often a bigger trade. In this event, we didn't get any new information. We didn't get anything new in the press conference either. The tone didn't really suggest anything. And that's then where you don't just sort of step back and say, oh, okay, we've not got anything from this central bank, there's no opportunities. This is where you can start then leaning on your structure and leaning on other trades that may well come to play, because there is so much more volume. If you look at the volume on the hourly chart, look at those volume histograms, much, much higher than anything on the prior 4 days. So that extra volume, those extra participants, is what creates the movement, and that's what you're looking for these structural completion trades. We'll go on now and we'll have a look further at more technical trades, beginning with a position squeeze. Okay guys, so on to the second technical play that you get over a central bank, and this is a position squeeze trade. Now, the whole premise of this move is that the market is pre-positioned. either pre-positioned for a technical play or pre-positioned in the expectation of the central bank doing something, of acting in a certain way. So you've got two different types of squeeze here. First up, you have technical plays. So people have got themselves into a position, perhaps, for example, trying to play the breakout of a wedge. Now, the idea here is that you've now got people, say, short at the bottom of a wedge, looking for that move to go down. What that then means, and this is similar to the play that you got in the Euro that we discussed over the ECB. What that then means is you've got a lot of people who are in a position with quite tight stops, essentially not wanting to take too much risk on this trade. What can then happen is you get a stop out of those positions, there's your squeeze, and then the move continues in the way that it was going to go. So that's your first way of looking at it. The flip side of that is, rather than people having positions for a technical play, a sort of technical breakout type move, is more where you've got a directional move into the event, into the central bank decision. And then what happens is it's not so much a squeeze of the positions going into it. So say, for example, you get a move up on a play for a certain central bank decision. What that's showing you is that people are positioned now long going into this. What would you do if you were long going into a decision? Well, on that decision, if you get the decision that you're expecting, there's your chance to get out of the trade. So you're using the liquidity of the new buyers that come in on the release of that decision to get yourself out. What this then serves to do is create a spike in the direction of the original move, and it's the new positions that enter on the perceived new information from the central bank, which ultimately it is confirmation of new information, confirmation of that decision. Those new positions that jump in then get squeezed in the opposite direction as the traders who already have their positions use those new entrants as liquidity to exit their existing positions, and it's then the new entrants that get squeezed in the opposite direction. So what we'll have a look at is, I've got two different examples here, both over the Bank of England, and one example of positioning going into it, whereby that positioning is then, the move plays into that positioning trade, and you then get the squeeze in the opposite direction. And then the alternative, where you have a technical setup positioning for that technical play that is then squeezed in the opposite direction before that move completes in the same way. Now, considerations for these type of trades. In your planning of any of this, or a trade like this, and you can plan for a trade like this, in your planning for it, what you need to be thinking about is, where are those positions going to exit? So the positioning of the market, what are those people going to do? So put yourself in their head. What would you do if you had that position? So where would those people get out? And also, in doing that, you're answering the question of, where could that squeeze reach? So, for example, you may have short positioning and a level a fair bit higher up, commensurate with a standard sort of central bank type move. So if you're looking in the pound, for example, something between 60 and 100 ticks higher perhaps, you could be looking there and thinking, okay, well, maybe that's where the squeeze could go. The stops could get dragged out up to that point, and then we can turn around. Now, that's giving you a little bit of scope, a little bit of an idea of where you might want to try and execute a trade. The next step is, how do you execute that? And you've got one of two options here. First up, and this is more a case where you have a technical type positioning, is a fade. The idea of the fade is, if you get a rush against that technical positioning, that's going to jump to a certain point and give you the opportunity to go straight against that move. There's your first trade then, and so that's a very quick, as we've talked about before, quick jump up, sell into the move as it goes up. The important thing here is that you don't get anything from the central bank that is overtly out of line. So you don't really want a binary trade situation. If you have a very binary type trade situation, that could completely change the dynamic of the market. So that's your first opportunity. The alternative to this, and the perhaps slightly safer route, is to go for the reversal trade. So once the squeeze has happened, you're then using that information, that inability of the market to keep a move going in one direction, as your reason to play the reversal. You've got a couple of different options here. First idea is going to be a move back through the scene of the crime, so back through the point where the move began. And that's quite a common trade to see over a central bank, where people jump on the first piece of information, and then as more information comes out, the interpretation changes, and that takes the market back through the scene of the crime, back through the point where the initial move began. That's your first reversal idea. The alternative to that is waiting for an access point to develop. You're not going to know exactly where that point's going to be, and so pre-planning that isn't really something you can do. But what you can be thinking is that if you get that squeeze type move, there is going to become a point that allows you into that trade. I'll try and talk that one through when we go and have a look at the technical squeeze and reversal in the coming slides. So let's go and have a look at the first example of this, and this is a move over the Bank of England, where you have had the market position itself into the decision. So let's go and have a quick look at that. First up, we're going to have a look at a situation where the market has positioned itself into the event. So what you can see here in the pound is that we've had quite a rally going into the Bank of England decision. Past 3 days, and including the morning of the decision, the market has rallied. We've moved up from around about the 139.40s all the way up to around about 142.30, so around 300 ticks of upside activity. What this is suggesting to you is that people are playing for this move. They're getting themselves into long positions in the expectation that the Bank of England is going to suggest that potentially rates could still rise in May, and give some kind of indication as to how that's going to happen, potentially vote in accordance to that as well. So we're getting a movement into this. The other thing to take from the technical player here is that going into it, looking at the profiles, and what you can see here, you can see the profile of the move itself, which is the profile furthest to the right. The profile to the left in the middle of the profile chart is an indication that the market is becoming stretched. We've seen a close that is a long, long way higher, the close indicated by the red asterisks. This is much higher than where value was the previous day, which is down at 141, 42, 44 area. So the market's now getting a little bit stretched. Think about what that means for those who are in positions. If you're long, and perhaps you've been long for a couple of days, yes, the market's becoming stretched, but ultimately you're still on side. You're playing for the Bank of England to give a more hawkish decision. Now, what are people going to do when that happens? What's going to happen is, as the move jumps, as people buy based on the hawkish decision from the Bank of England, those who are already long are going to use this as an opportunity to sell, to exit their positions. And this is where the squeeze comes. The squeeze comes on those who buy on the decision. They buy on the decision, create the spike up, and then they get squeezed in the opposite direction as the market starts to come back. So let's go and have a look at the expectation. Expectation is 9-0 for unchanged rates, but still potentially an indication that they could hike in May. So 9-0 for an unchanged of rates. We've got highs all accumulated around about the 142, 22s to 27s. So that's going to be your area that if you get any jump above there, you're expecting people to start taking profit. The result is that you get 7-2 vote for a hike, so 2 people voting for a hike. However, the interpretation side of this trade is that they add the information that data is broadly consistent with February. So whilst 2 people are voting for a hike, currently data hasn't changed, And so therefore there is no reason to believe that they are likely to hike rates anytime soon. It is just a couple of members. So what you can be thinking here is those who have played long into this are likely to get out. Those who have just bought it on the 7-2 are now in a sticky situation. And this dynamic can add to the selling, giving you a target initially of back down towards 142.04, the previous day's high, and then back onto the top of value, which comes in at 141.44 to 46, which is also a previous high from a few days prior. So you've got targets. The hard part of this trade then is how to enter the trade, and we'll go and have a look at this on a 1 minute in a moment to see where exactly you could have got into this trade and how you could have executed the trade, as well as what to expect when you get in, because that's the other really important part, and particularly important when you debrief in these types of moves. How exactly does that move play out? What are you looking for when you enter that trade? That way you're managing your expectations going forward. If you expect a move to take half an hour to play out because it's a passive continuation on a reversal, then you're able to sit with it. But if you get into a move expecting an instant reaction and a very quick move that puts you on side, you're going to struggle to hold on when it takes its time to actually play that move out. So that's the important thing to take from this. We'll go now and have a look at it on a 1 minute, have a look at where those opportunities were and how you could have played this trade. Okay, so here is the reaction that we got. The first jump up, we moved from 142.10 up towards around 142.70. There's your spike up. That's the reaction to the 7-2. That takes you through the recent highs at 142.22, 27 area. And that's where people are then rushing to buy. Those who are already long are going to use this as an opportunity to exit, to take their 300 plus tick winner. And that provides some selling pressure. The next element of selling pressure comes from that aforementioned piece that data is unchanged since February. So now you've seen the squeeze, you're starting to see the squeeze. People have entered and the market's starting to come back on them. Now what you've got to do is try and find your entry point. First opportunity here, and we tried to break this down into 3 opportunities. The first trade is a fade. As it jumps up, you can fade it on that very fast move. Now the difficulty with this is we don't have a great deal of reference point. There's no clear level that you can say that would be a good point to fade from. So that makes it quite a tricky trade. Your next step is then actually planning out an access point. How do you get into the next leg of the trade? Now what you can see is that the market falls back and starts to hold above the morning's highs. Morning's highs right around that level, 142.27. So we begin to hold that. And what you're looking for here is then a change in price action. You're looking for a little bit more pace to be coming into the market, more volume getting put through. And that gives you the opportunity then to play a breakout or a breakdown trade back through the morning's highs. And what you're looking for then is a relatively quick move down towards the previous day's high, which comes in at 142.04. This plays out rather swiftly and actually plays out in about 3 minutes. So there's your quick first move, but still remember, we've now spiked to the upside. We've still got people who will be positioned thinking that you're going to get then a pullback and a progression further up. So we've still not seen all that positioning coming out. Remember, this is also a market that has traded up into this move. So you've got a lot of positioning long that are all going to have stops lower and lower down as the move starts to pull back. So your second trade then is to be looking for a passive entry. Previous highs, remember, were 142.22. So you get a pullback up there, and as long as we're not getting back above those previous highs, that's where you have an opportunity for a passive entry to sell as the market rises back up, with the intention then of running this right the way down towards the previous day's value area high and those previous highs at 141.46. That's your bigger target. Now, the important thing to be thinking about here, or to be taken from this, is that this second wave trade is a trade that's going to take much longer to play out. And in fact, takes around about 2 hours to actually achieve the move. The move's a full 80 ticks to the downside, but it takes 2 hours to do it. And this is something you need to have in your mind when you're taking these trades on. That yes, you can see the entry point, yes, you can see the target, but what often happens is then the middle part goes out of people's heads, and all they focus on is the idea that I'm in here and it's going to go here, and they view it as a straight line move. Now, it's a second wave trade, so this is going to have, the market's going to have slowed down. You can see that volume's fallen off by this point. So you're going to get a much steadier fall from here, a much steadier drift down that's going to take that little bit longer. Now, if you've planned for this and you're ready for it, then that makes an absolutely fine trade, because you're able to then hold on to it. And your particular point of confirmation is when it breaks the lows at 141.90s. They were the lows that we'd established on the back of the initial pullback before the bounce up to give you that passive entry. So once that breaks, then you're confident that the trade is on. That's where your confidence increases, and that's where you can say to yourself, this is going to work. Maintain your stop above the previous day's high, above 142.04, and then you can start targeting that larger move down. So that's how you'd be looking to try and play this. Two opportunities, predominantly. The breakout to the downside for that initial reversal trade, followed by then the passive entry for the much steadier continuation move. You can play this as a combination, that you get in on the first trade, cover some, and then add in for the second, or this can be played as two distinctly separate trades. One, the first squeeze of those initial buyers that buy at above 22, and then secondly, as a passive move for this steady continuation to complete the move all the way down towards 140, 146. So two different ways of playing that same idea. It's all about recognizing that people will have given up on their long positions as you get the spike up, use that liquidity to get out, and it's the new buyers who enter at the top of a range that are the ones that get trapped, and they get squeezed back the other way. We'll now go and have a look at a technical reversal or a technical squeeze of positions followed by the continuation. So both reversal type plays. We'll go and have a look at that. This provides a little bit more of a clear fade point, a clear sort of reference point where you could fade this, and you'll see the difference in the nature of the market going into the event. So we'll go and have a look at that. This time, the Bank of England once again, but in August in 2018, a few months after this decision had been made. Here we're going to look at a technical reversal. So a reversal of people who are positioned for a technical trade as opposed to positioned in the expectation of a certain event from the Bank of England. So in this situation, you can see the very clear difference. No trend move into this, no directional play into this. The market has been sitting for a couple of weeks between 131 and 132. It's also developed into a wedge, which we're beginning to get towards the end of. And this is where the technical play first comes in. From the morning's trade, and you can see the entirety of the move here, but the morning's trade gives an opportunity to play the break of the wedge, which also coincides with an inside day. The previous day was an inside day, so as that inside day breaks below 131.19 and breaks the wedge at the same price, you've then got an opportunity for a short. Excluding the Bank of England from this is a trade that you would be looking to take. Good technical setup, provides reasonably tight risk reward, that you're playing a breakout below the inside day through the wedge and looking then for a move into the consolidation that you can see on the left hand side of the chart, and particularly down to where the majority of the volume is in the 130.60 to 50 range. So that's going to be your main target on this. Now, what's happened so far in the morning coming into this decision is there has been a move out of the wedge that has tested down to 130.90. This is where positions are getting accumulated. People are trying to play for this larger move, getting themselves short below the wedge in that range between 19s and 90s, looking for the continuation and potentially for the Bank of England decision to help with that continuation. Now put yourself in those people's shoes. If you were short on the break of the wedge, on the break of the inside day, where would your stop be? Well, for most of these people, or for many of them, their stops are going to be back inside the wedge, back inside the inside day. And this gives you the clue of a potential squeeze of positions. That anything that turns back up inside this wedge, all of those shorts who played for that continuation, that breakout below the wedge, below the inside day, are likely to come out. And remember, you get lower liquidity over these central bank decisions, so that's potentially going to create a larger move to the upside as well. The added benefit here from a technical point of view as well is that you've got a reference point for this squeeze. You're likely to get people wanting to sell the top of that wedge, wanting to sell that downtrend. So a move back up towards 131.73 could well be your opportunity to fade, to sell any fast spike up for the move lower, assuming that you don't get anything overtly hawkish, for example, a rate hike or a very, very strong vote for, not a very strong vote for a hike, a strong vote for a hike and an indication that we would get further hikes in the future. So, in terms of expectation, what we're looking for here is a 7-2 vote for a hike and the suggestion that you're going to get 3 hikes over the next 3 years. So we're expecting a rate hike and we're expecting 3 hikes to be indicated over the next 3 years. Now what you in fact get is you get a result of a 9-0. So no dissenters to this rate hike. Everyone votes for the hike. And this is what then squeezes those short positions out. The initial reaction is this is hawkish, squeezes the short positions out, gets the spike to the top of the range and then reverses. Another interpretation element, much like the previous, is that they suggested that it would be 1.5 hikes over 3 years rather than 2, and that Brexit risks are still prevalent. And so therefore, the indication that hikes are going to be ongoing and perhaps more aggressive than people thought is no longer there. That's very important, and that's what turns the market back down. Once again, we'll go and have a look at this on a 1-minute chart in terms of picking out where you could enter these trades, where those opportunities were. What we'll then do is contrast this with how it actually trades on a ladder, because it's very easy to pick trades out from a chart. And this is where that debriefing element is so important. Looking back at how exactly it did trade, could you have got into any of these opportunities? So we'll have a look at it first from the point of view of where seemingly you could have entered trades. And then we'll go and have a look at it from a ladder point of view as to how exactly you may well have been able to execute those trades. So let's go and have a look at that short-term chart. Okay, so here what we've got is the 1-minute chart as well as the screen dump, the release of that information. And you see the 9-0 is the first thing to come out at the bottom. Remember, you read from the bottom upwards. And then you get a little bit higher up. The reference to the market rate path flatter than in May implies bank rates of 1.1 in 3 years' time. That doesn't suggest 3 hikes over 3 years, because we're already now at 0.75, so it suggests only 1.5 hikes. So that's where you get this fade opportunity from. Now, looking at a chart, your first thought is, well, you have the fade from the top of the range, up at those 73s. So that's your first trade. Jumps up on the 9-0, and there's your fade. What you then have to do, and we'll see this on a ladder, is the actual trade opportunity there comes more in this fast recognition of a range establishing between 130-150s to 20s, and we'll see that range then trade up and down, up and down. Next up, you're then looking for a breakout trade, and with a lot of these types of trades, it can take some time before you actually get the opportunity to take the trade on. And this is what I mean about trying to find your access point. It's not always going to be crystal clear where you can get into this trade. You can't plan beforehand where exactly you would want to get in. What you do know is there are some very key reference points. 130-110, for example, was the previous lows and the point where people were looking for this breakdown on that inside day and the wedge break. We'd also established lows at 90s for the day. So a break of 90s then accelerates this idea of falling. It also means that anyone who has bought it on the decision is definitely wrong. No one could have bought it on the decision and still been on side when you get through the low of the day. So what you're starting to look for then, and this comes into trade 2, the breakout element, is clues for this. And what you see is we have around about 45 minutes of sideways trade, but you get a very good clue that once we've established this range between 20s and 50s, is you then start to get quite this heavy sell-off, comes a few minutes after the decision. Heavy selling back down once again towards 130-110. So we're seeing that the sellers are willing to take control here. Don't get any movement back up, and so the 130-110 then becomes your access point. We've tested it. By the time the breakout comes, that's been tested twice. You're looking then for your entry as it breaks through there. And as it breaks through, potentially a pullback and a stall there to give you a passive continuation trade. So that's your third opportunity that you play in the passive trade as you break 10 to get in, still with the intention this is going to fall through 90 and then continue down towards that 130, 60 to 50 range. In terms of your exit, what you're looking here for is any exhaustion into that zone. So rather than putting a definitive this is the level on it, use the price action to show you where that level could be. So as you get this exhaustion move down, this fast drop into 60s, that's your clue. That's the place to be getting out of your trade, and that gives you opportunity to exit. If you want to hold on further, you can do, and we'll see that from the price action from the ladder, where exactly you could have held on to this trade, and some of the clues that you should be looking for, and some of the things that you'd be putting into your debrief as to how exactly this traded to learn from in the future. What I've done here is, if you look at it purely from a chart point of view, there seems to be some very easy and very obvious trades to take here. We'll see on a ladder how particularly the fade at the top of that range was a very, very difficult trade to actually execute. So let's go and have a look at that, and we'll go and have a look at how this was actually traded. Okay guys, take note of where the pound first starts. The video will stop in a moment and you'll see the initial spike on the very first release, instant up towards 75, giving you very little chance of getting in. Now what you can see there, and as the box showed, it was instant to 75 and straight back to 40. This meant that the only way you could possibly fade this was by having an offer there. So your next area of fade is to establish where the market's ranging. We've seen a trade up towards 50 and we can't then get beyond there. What typically happens after the first spike is we get a bit of trade that creates a small range. There again, once up more, up towards 50s, and we find resistance. So this range is now being established. 130, 120s up to 50s. Remember, 130, 119 was the breakout point. That was your inside day break. So we're staying just inside there. Holding above 20s, trading up to 50. So if you're looking to play the long trade here, the continuation to keep the move going towards new highs, you have that opportunity. You'll be playing this trade as long as we're staying above 20s, you're looking then for a break of 50s and a continuation higher. But what we start to see here, we're just over a minute after the event. Volumes have started to fade a little bit. We've started to slow down. Once again, another push up to 50. Do we see any continuation? No. So what we've now got is a range that we're waiting to see the break of. Now, from a technical point of view, those shorts could well now have been viewed as being squeezed out, and we're then going to get new shorts established on a break back below 19s and 10s. So that's going to be your idea. If you are sticking to this technical view that we have a position squeeze up based on the technical wedge break, that position squeeze up, then we're looking for more selling as we come back below 19s and 10s. Whilst above there though, whilst inside the inside days range, we've still got scope to the upside. And also based on the slightly more hawkish decision from the Bank of England, we've still got scope there. So there we go, down towards 20s. And we're starting now to actually just have a little bit of a tip through 19s, 20s. Find support again. You now need the support to act and start giving us a buyers, bringing the market back up through the 25s where the average price is, back up towards the 50s once more. But what you're now starting to see here, it's struggled at 25. We've had another attempt at selling here. This could be your first attempt at the breakout trade to the downside through the 19s. If we can get through 10s, then you should get the acceleration. So here's the first push down towards 12s, 13s, and we find some buying quickly. Now the important thing here, if you're going for the short, is that we don't break 19s. If we get back above 19s, then your reason for the short is no longer valid. And also the more important element is you're looking for it to move back through 10s. We're not seeing that. We're now starting to tick back up above 19, and so we can now start looking for a move, particularly if we get through 25s, all the way back up towards the 30s to 50s area. So the first attempt is not there. That first attempt lower has failed at 19s. We're now starting to tick back up through the range. And still a potential opportunity. Those who are long, they're still feeling they've got a little bit of comfort in this trade. They're still slightly safe on this, and we can still be looking for a further continuation up towards 50s and then potentially all the way up towards the new high. So we're back into that range and back consolidating once more. This is giving us a little clue. We're starting to establish a low that's important down at 12s, which also coincides with those previous lows where the main part of the breakout is likely to come from. So that's what we've managed to establish so far. Remember, these trades often can take a little bit of time before we get the next leg of the move, and so you get 45 minutes now before the next leg. The next video will show the final leg
Okay, now we're on to the ECB. This, I think, is the central bank that perhaps provides the greatest number of opportunities, not least because of the fact that you get a press conference with every single interest rate decision, but the way the ECB communicates can often lead to quite a few ad hoc trades that you can't necessarily see coming, but will provide surprise opportunities throughout the days, weeks, months in between meetings. You also get a question and answer session on every meeting with the ECB as well, which offers, again, further opportunity to dig into what their thinking is, and this way you perhaps get a little bit more information from the ECB than any of the other central banks. So let's go and have a look at the ECB, what their policies are, what tools they use, so you can familiarise yourself, and then again it will be an interpretation trade this time to practice your skills and trading.
Sort of large directional move opportunities, scalp opportunities.
So a quick overview of the European Central Bank. It's established in 1998 to manage the euro area economy. It's one of the newest central banks in the world, and this is due to the advent of the euro. Prior to that, every European country had its own individual currency. So once that became centralised, you then needed a European central bank to manage that. In terms of their mandate, it is, much like many other central banks, price stability, but it is only price stability. And this is quite clearly defined in relation to inflation as a year-on-year increase in a harmonised index of consumer prices for the euro area of below 2%. So basically they want inflation below 2%. They will reiterate the point that they want to keep inflation below but close to 2%. They still want growth in prices, but they don't want this over 2%. So 2% is seen as a very hard line. It's not like the Bank of England that's symmetrical. It's a very hard line that the ECB intends to stay below at all times, and we use monetary policy tools to achieve this. Now, the way that these tools work is a decentralised situation. So the ECB will coordinate policy, change policy, but it's actually the individual central banks of each member state that carries out the transaction, so the open market operations within their individual state. So individual central banks still maintain some control, but ultimately they have to implement policy that has been created by the ECB. Let's go and have a look at the ECB board members. So with the ECB, there's a slightly convoluted structure. There's a governing council, which encompasses an executive board consisting of 6 members. These have permanent positions and will always be part of the decision-making process at any meeting. Any member of the governing council of the executive board will have an 8-year term. Outside of that, there's then the 19 heads of other European central banks. These make decisions on a rotational basis, so you would always have 15 of the 19 making a decision on any meeting. Now, what I do want to bring your attention to is the first 5 in the list on the left of the other central bank governors get more votes or more chances to be part of the decision-making process than all of the rest of them. This also skews the ECB towards the more northern part of Europe, with Weidmann being Germany, Lind Spanish, Villeroy French, Visco Italian, in fact, and not Dutch. So you can see where the skew is to the more northern part of Europe. Likewise, when you go onto the executive board, Draghi's from Italy, Constancio Portugal, Kur France, or Kure France, Lautenschlager is German, Mersch is from Luxembourg, and Preyet is also German. So whether this has a bearing on decision making in the ECB is up for debate, and that is something that is more peripheral to the way they actually make decisions. Now, in terms of voting rights, every member gets a voting right. However, these are never published. The vote is never actually published, and the decision is termed as either unanimous or not. That is all that you get from the ECB. So it's more that a decision is come to, despite the fact that every member can have their individual input to that meeting. So take note of who's hawkish, who's dovish, and the other thing that I do want to point out, going forward, is when the terms end of some of the executive board members. We will see in the next year and a half, going from the beginning of 2018, Draghi, Constantia and Prayet all leaving. So the three top jobs, the President, the Vice and the Chief Economist, all leaving the ECB. Now all three of these members are reasonably dovish, if not very dovish. So this switch is likely potentially to switch to a slightly more hawkish ECB going forward. So just something to keep in mind and be very wary, or very aware I should say, of who is going to come in and take those positions. So understanding the hawkish or dovishness of other members can be very important going forward as you then start getting news on who will replace Draghi, Constantia and Prayet in the future. Right, let's move on. Have a look at the ECB meetings. As I've already mentioned, the ECB conducts 8 meetings a year, much like most other central banks. But the difference with the ECB is that they do a press conference with every meeting. Also, there is no pre-release of the statement either. So, rather than with the majority of other central banks, the statement comes out when the decision comes out. So, say rates change and then the statement all comes out together. You don't get a pre-release of that statement. So the statement is at the beginning of the press conference. So Draghi will read the statement. So as you hear it, it's the first time it's heard, meaning that any words, any changes within that statement can be acted upon in real time. Next up, you also get staff economic projections. These come about in March, June, September and December. This typically has been the time when the ECB will act if it is going to change any type of monetary policy tools. It's not a hard and fast rule, but changing when they have the staff economic projections is often
Okay, guys. So
a way that the ECB likes to go about things.
That you get over a central bank, and this is a position.
Much like every other central bank, there is a blackout period. The whole premise of this 7 days prior to the meeting.
The market is pre-positioned.
However, and this is where again the ECB does provide you with numerous extra opportunities. You will often get unnamed ECB sources. So you will get an article or a piece of news comes out from an unnamed ECB source.
First up, you have
often giving a little bit of a clue as to what may or may not happen at the meeting. Now, you don't know the timing of these. These sources could come out at any time, so you should always be aware of them. We'll have a little bit more of a detailed look in a minute at how sources can affect the market and where those opportunities are.
This is similar to
so
the play that you got in the Euro.
We'll come on to sources in a little bit, but that blackout period from 7 days prior, so theoretically you will not hear any one member of the ECB speak in 7 days prior to the ECB meeting.
What can then happen is you get a stop out of those positions.
Format of the release. So what we have is 12:45 release. This is where you get the decision on stimulus, the decision on rates, and you will also get a brief explanation of those decisions, particularly relating to forward guidance. Again, we'll come on to this and look at it in a little bit more detail in a few moments' time. And then at 1:30, you get the press conference. This is where Draghi will read the full statement and then answer questions. This usually goes on until around about 2:30 UK time.
On a play for a certain central bank decision.
This is where you can have additional opportunities to trade based on your interpretation of what Draghi says in that press conference, as well as his answers to certain questions. Previously, or I say previously, prior to the beginning of 2016, the ECB would only release the interest rate decision at 12:45.
What this then serves to do,
you would then
is
wait
create
until the press
spike in the
conference to
direction
get in real time
of the
all of the rest of the
original
decisions and any
it's the
forward
new
guidance.
positions that enter
Now, the
on
way
the
that the
perceived
information is
new
received
information
varies
from the
depending
central
upon
bank, which
your
ultimately
news
is
source. So if you're watching it through the TV,
of new information,
on CNBC,
confirmation
on
of that decision.
Bloomberg, on another news
Those
channel,
new positions that jump in,
likelihood is you will be
then
around about
get
5
squeezed in the
seconds
opposite
behind
direction as
those who have got the direct feed
the
to
traders,
the press
the traders
conference.
who
So
already
be
have
aware
that
of that
position,
in
use
terms
those
of both
new
if you've got the
entries
direct
as
feed and
liquidity
you
to
execute a
exit their
trade,
existing
then
positions, and it's
it
then
may
the
take
new
a few
entries
moments to
that
actually
get
start to
squeezed in
move
the
as
opposite
everyone
direction.
else starts to hear it
So what
on the
we'll have a
news
look
channels.
at is I've got two different examples here. both
Conversely,
over the Bank
if
of
you
England,
are watching on a news
and
channel
one
and you see a
example
quick
of the
move,
positioning going
this could
into
be
it, whereby that
showing you that
positioning
the
is then
new information has come out.
the
But
move
when
plays into
that information
positioning's
gets to you,
trade,
you need to assess how
and
big a
you then
deal
get
is
the
it?
squeeze
Are
in
you
the
still
opposite
willing to
direction.
trade off this
And then
information
the
once that initial
alternative, where
move
you
has
have a
already
technical
happened?
setup,
So
positioning
something to
before
really
that
be very
technical
aware
play
of,
that is
depending
then
upon what
squeezed in
news
the
source
opposite
you're using
direction
to
before
listen to that
move
press
completes
conference.
in the same way. Now, considerations.
I've
for
given
these type
you
of
a
trades.
link just below to all
In your
previous press
planning
conferences.
of any of this,
ECB
or a
gives
trade like this,
every
you
press
can-
conference
you
with
can
Q&A
plan for a
going
trade like
way
this.
back until the
In your
start of
planning
the
for it, what
ECB,
you
so
need to be
all of the
thinking about
previous
is where are those positions
ECB
going
heads
to
as
exit?
well.
So
You can read through
the
that. What I
positioning
would
of the
suggest
market,
when
what are
reading
those
through
people gonna do? So
the
put
ECB
yourself
previous
in
press
their
conferences,
head. What would you
you want
do
to
if you
read
had
the
that
first
position?
2
So
pages.
where would those people get out?
That's
Also,
where any change in
doing that,
language
you're answering
particularly
the question
comes
of
up.
where could that
Um,
squeeze reach?
Understanding that,
So,
and you'll start to
for
understand the
example,
very
you may
clear
have
structure
short
with which the
positioning
ECB
at
goes
a level
about
a
its
fair bit higher
statements,
up,
and very clear how
commensurate
certain
with a
areas of it
standard
change. So
sort of
watch that
central bank type
consistency
move. So if you're
or
looking at
inconsistency
the
when it
pound, for
does
example,
change.
something between 60 and
And
100 ticks
finally,
higher, perhaps.
you get minutes from the ECB.
You could be looking there.
Unlike the
and
Bank
thinking,
of England,
okay,
which
well,
publishes
maybe
minutes at the
that's where
same
the
time
squeeze
as
could go. The
QIR,
stocks would
the
get
Quarterly
dragged out
Inflation
to that
Report,
point, and then we
and
could
its
turn
rate
around.
decision. The
Now,
ECB publishes
That's
minutes
giving
3
you a little
weeks
bit of
later.
scope, a little bit of an idea of where you might want to
Generally,
try and execute a trade.
The minutes will just reiterate what happened
step
at the
is how do you
Governing
execute
Council
that? And you've got
decision.
one of two
However,
options here.
there have been a couple of rare
First
occasions
up,
where
and this is more
the
a case
minutes
where
have
you have
actually
a
been
technical
used or have actually been
type
able to give a
positioning,
little bit of guidance
fade.
going forward. And this
The
particularly
idea of the
happened
fade is if
February
you,
the
if you get a
16th,
rush against that technical
2017.
positioning, that's going to
The
jump
ECB
to a
released their
certain
minutes,
point and
and
give
we'll
you the
go on,
opportunity to
have a
go
quick look at the
straight
next
against
slide.
that move.
This is what you got from the minutes.
There's your first trade.
Basically,
And so
what the
that's a
ECB
very
minutes
quick,
were
as
saying
we've talked
was
about
that
before,
there was
quick
potential
jump
for
up, sell
adjustment in the
into
capital
move
key.
as
Now,
it
you'll
goes up.
remember from
The
the
important
beginning
thing
part
here
of the course
is
when
that
we
you
talked
don't
about
get
central bank
anything
preparation,
from the central bank that
how
is
the capital key works. It's to
overtly
do with the
out of bounds. So you
allocation
don't really want
of
a
bond
binary
buys between
trade
different
situation.
countries.
If you have a very
Now,
binary type trade
the
situation,
thought is
that
that
could
if
completely
a capital
change the
key
dynamic of
shifts,
the market.
it is likely to favour the more
So
peripheral
that's your first
nations,
opportunity.
i.e.
The
Italy,
alternative to this, and the perhaps
or the
slightly
more
safer
southern nations
route,
in Europe,
is to go
to the
for a
detriment
reversal
of
trade.
German
So
bonds,
once the
because
squeeze
they
has
are the
happened,
most
you're then
bought
using that
asset in the
information,
ECB's
that
QE
inability
purchases.
of the market to
So
keep a
the
move
minutes
going in
stated
one
that while
direction
significant
as
weight
your
has also
reason
been
to
placed
play
on
the
limited
reversal.
deviations from the ECB's capital key,
You've got a
it's
couple
also
of different
underlined that
options
limited
here.
and temporary deviations
First
were possible
idea is going
and
to be a move back through
inevitable.
the scene of the crime. So back
Thus, there
through
was
the
some room
point
for
where
a
the
trade-off
move
between
began.
relative
And
deviations
that's
from the
quite a
capital
common
key
trade to see
across
over a central bank,
jurisdictions
where
and
people
limiting the
jump on
extent
the
of purchases
first piece of
below the
information,
DFR, that's
and
the
then
deposit
as more
facility
information
rate.
comes out,
So
the interpretation
basically, in
changes,
order to
and that
not
takes
buy
them
bonds
back
from below
through
the deposit
scene of the
rate,
crime, back through
the
the point
ECB was
where
willing
the
to see
initial move
slight
began.
deviations in the
That's
capital
your
key.
first reversal
What this caused,
idea.
and we'll go
The
and have a look on
alternative
the
to
next
that
slide,
is waiting for an access point to develop. You're not going to know exactly where
was a
that
switch in a
point's going to be.
spread.
So pre-planning
So
that
what happened is
isn't
it gave
really
an
something
opportunity
you
to
can
buy
do. But what you
BTPs,
can
the
be
chart on the
thinking is
left,
that if
and
you
also
get
to
that
sell
squeeze
bonds.
type move, there is
Now, the
going
crucial
to
thing
become
to
a
note
point
here,
that allows you
BTPs
into
on
that
this
trade.
comment went straight up 2 minutes, and the BTPs rose around about 100 ticks. The Bund in the first minute following these comments actually drifted up with the BTPs. You see that first little green candle before the 4 or 5 red candles down. And that's because the BTP shifts higher, the Bund gets dragged with it before realizing the implications of the comment, And so actually you end up with a better opportunity of selling the Bund because of the fact it has been dragged up when actually it should be coming off. And the Bund then does turn and takes about 40 ticks to the downside. So offering you a very nice trade placement on these comments. Again, this is something that comes out consistently 3 weeks later, so you can be prepared for it. And much like a rate decision or a central bank decision, you can have your preparation done and be very ready for exactly what's going to happen.
They're getting themselves into long positions in the expectation that the Bank of England is going to suggest.
We're going to tackle the ECB toolkit in 2 parts. First up, we'll look at rates, and then we'll look at their extraordinary measures, of which they have got multiple. So all of these need a little bit of explaining. Now, the ECB has 3 published rates.
The other thing to take from
they're the main refinancing rate.
Is that going into it,
this is the rate for 1 week borrowing from the ECB. It's the main instrument for managing liquidity. So this is the rate that all of repos are based around. So that's their main rate, and it's currently at 0% beginning of 2018. Next up, and a rate that has become very focused upon, is the ECB deposit rate. Now, this is the rate that the ECB pays on excess reserves. So banks have to hold a certain amount of money at the ECB. Anything above that,
so the market's now getting a
the ECB will pay will pay interest on, but as is the case with negative interest rates, is in fact charging interest on. So the idea here is that the ECB is trying to push that money back out into the economy by discouraging banks to hold money at the ECB. They'll be charged for it, and so therefore they should theoretically want to shift that money out into the economy and use it in other types of lending that is going to yield better than negative 0.4%. Finally, you have the marginal lending rate, and this is the amount of interest charged on overnight liquidity. This is a bit like the Bank of England discount window facility, so this is the sort of lender of last resort facility, whereby liquidity will be provided against eligible capital
expectation is
at a slightly punitive rate, or a rate above that with which repos are carried out. Now, the eligibility for this collateral, the ECB has consistently dropped. It was previously AAA collateral. It's then been dropped and dropped and dropped to allow central banks and commercial banks within the euro area to actually access this facility. So that's been the ECB, again, a sort of attempt at shoring up the economy and averting a crisis by allowing weaker and weaker collateral to be used for marginal lending facilities. And finally, in terms of guidance on rates, the ECB has used a very familiar or very well-used line to explain their guidance on rates, that their rates will remain at present, and in the past it has been present or lower levels for an extended period of time. That extended period of time is then either in reference to asset purchases or in reference to inflation rates. So, whilst asset purchases are ongoing, the extended period of time is well past the horizon of asset purchases. With no asset purchases, that extended period of time will relate until a progression of inflation back towards their close to but below 2% target. So there are your 3 rates from the ECB. Focus recently has been predominantly on the deposit rate. However, the main rate is that refinancing rate, which has fallen down to 0.
When you get in, because that's the other really important part.
If we go and have a look at how these rates have progressed over time,
how exactly does that move play out?
Be aware there's 2 axes on this chart. So the main refinancing rate in orange and the deposit rate in purple go down to different levels, 1 to 0, 1 to minus 0.4. So always maintaining that range between the two.
You're able to sit with it. But if you get into
again, much like the Bank of England, we saw a very quick move, fast drop during 2007. The ECB, though, because of their mandate relating to inflation, actually began to raise rates in 2011, way before any other central bank. This was because inflation was actually starting to creep up above 2%. Those rates were raised, but the European Union then fell into the European debt crisis, and this caused, when Mario Draghi took over, who is the current head of the ECB, when he took over, he then started cutting rates very quickly to provide some stimulus to the economy. So the ECB actually went contrary to other central banks in raising rates in 2011, and then again contrary to other central banks in continuing to lower rates throughout 2011, 12, 13, 14, 15, and even 16. So ECB is often slightly off kilt with other central banks, but you can see the progression of rates. And you can, again, see the ferocity with which rates can be cut if stimulus is needed. Central banks now, however, have got interest rates near the lower bounds, near zero. Can they actually decrease them any further? And where would stimulus come from, should the need come in the future?
As it jumps up, you can fade it on that very fast move. Now, the difficulty
beyond interest rates, the ECB has multiple other ways of providing stimulus to the economy. First up, there was extraordinary measures. These began in 2011 and took the form of longer-term repurchase operations. These were done at a fixed rate, which meant that whatever borrowings a bank took on wouldn't be affected by any movement in interest rates from the ECB. So there's your longer-term refinancing operation, and they were done for a fixed amount of years as well. So it was yearly repurchasing operations as opposed to the weekly version that is more typical from the ECB. This was then advanced in 2014 to targeted LTROs. And again, these were done with the intention, a lot like the Bank of England, of that money needed to be lent out in order to gain access to these TLTROs, as they were termed.
So there's your quick first.
So both operations were for 3 years and then 4 years, and the idea was that it would ease credit conditions for the private sector and households by providing additional loans because of the targeted nature of these LTROs.
Remember, this is also a market that has traded
Once this had come into play, the ECB then started to embark on additional purchases. We had the covered bond purchase program and the asset-backed securities purchase program in October and November 2014. These are basically a precursor to the ECB buying additional securities, buying government bonds. However, the idea was always that the ECB would buy these, and these transactions would be sterilised, i.e. they would buy the asset-backed securities from commercial banks, but then always with the intention of selling them back. Come March 2015, that's when the PSPP started, Public Sector Purchase Programme. So the ECB, you'll probably have noticed by now, does like an acronym. So be up on what each of these do mean. PSPP, Public Sector Purchase Programme. This was where the ECB went out and bought government bonds. Now, as I mentioned, it was the individual central banks from each country that would do the buying of these bonds, not the ECB itself. The bonds then all did sit on the ECB balance sheet. However, it was the individual central banks that took on the task implementing this policy. Finally, March 2016, we then got the CSPP, which is a corporate sector purchase programme, which was in addition to the PSPP and was purchasing of corporate bonds from non-financial corporations. This created an interesting situation whereby certain car companies, because they earn a fair bit of money from financing loans to buy cars, actually couldn't access this or couldn't have their bonds bought. So just a little nuance there for you to think about. Now, conditions of these additional purchases, PSPP, CSPP.
So once that breaks,
they couldn't buy any more than 33% of an issue or an issuer's bonds. What that means is that any one issue of bonds, the ECB can't buy more than 33%. Also, from any one country, the ECB can't buy more than 33% of their bonds.
So that's how you'd be looking to try and play.
Bonds must be bought in accordance to the capital key.
Two opportunities.
So what this again led to was a surge in buying of German bonds because of the fact that they had the largest percentage within the capital key. Bonds were bought with a maturity of 2 to 30 years and they couldn't be bought below the deposit rate. Now these were both changed in 2016. This was to counter a scarcity of German bonds. Because of the fact that German yields had dropped below the deposit rate, the ECB then couldn't buy enough German bonds to stay within the capital key. And also because of the issuer limits, they couldn't buy more than a certain number of bonds from any one issue, leaving them with a scarcity of German bonds to buy that actually yielded above the deposit rate. They dropped that deposit floor in December 2016, as well as the maturity, so they could buy a lower maturity, i.e. 1 year bonds. So that's their extraordinary measures toolkit. Go and have a little look at the next chart and it will show you exactly how this was played out throughout the months.
Fade point. A clear sort of reference point.
So, ECB, unlike the Bank of England, who had a maximum target of purchases, merely had a stated monthly purchasing amount. So this started off as 60 billion in March 2015, and you can see every month 60 billion was bought. This then got upped in March 2016 to 80 billion a month,
here we're going to look at
before then being lowered back down in 2017 to 60, and then going into the end of 2017, the announcement that it would then be dropped to 30 billion a month. So there was a consistency in how much they would buy each month. Also, something else to note is the way the ECB's purchases dip in July and November. This is preemptive of the limited liquidity in summer markets and also over the Christmas period. So what would happen is the ECB would front load purchases prior to July and then reduce the amount of purchases for that month and then backload them again just after July, likewise in December as well. So you can see where the majority of purchases have been made up, pretty much all from the PSPP and then a smaller part added on from the CSPP. The other earlier purchase programs, the CBPP and the ABSPP, reasonably limited in their impact on the ECB balance sheet and their increased purchasing each month. So the real big stimulus did very much come from the move in March 2015 to boost QE and actually push that into government bond purchases.
60 to 50 range. So that's going to be your main target on this. Now,
understanding how the ECB communicates its rate decision is crucial. It comes in a reasonably consistent format, and this comes at 12:45 on the first release. So what you'll get here is you'll get the decision made, and then also certain elements of forward guidance, taking away a lot of the opportunity from the statement. However, there are still quite a few opportunities there, and we'll talk about that in a little while. So first up, you get the rates decision. Note here, look at the time that it comes out. It is not often bang on 12:45. This 12:45 in 21 seconds. So you'll get the rate decision. The ECB will state whether it is unchanged or raised to or lowered to on each of the different rates. Next up, you get the asset purchases. This is a statement regarding the asset purchases, how much they are, when they're intended to continue until, and the final caveat that the ECB puts in is all beyond if necessary. What this means is that asset purchases are open-ended. Effectively, they will buy until a certain date that they specify, However, it always leaves the option that they could go beyond that, and they could then extend the duration of purchases out a further 3, 6, 9, 12 months, however much they decide. So that line of beyond or necessary, or beyond if necessary, is very, very important. So that's the first part of their forward guidance. Next up, they have guidance on sequencing. And this is where I mentioned before that reference to interest rates remaining at present levels for an extended period of time. This is the key guidance that the ECB gives. Throughout the asset purchases, as I mentioned previously, this always related to the end of the asset purchases, so well beyond the horizon of asset purchases. So in this example, beyond September 2018 and well beyond that. There's no specifics on what well beyond means, and that's where the market interprets it and may push well beyond out to a year beyond, 6 months after the market decides to interpret it. But that's the key bit on sequencing, the at present levels for an extended period, and then they will relate those present levels for an extended period to either asset purchases or inflation.
Another interpretation element,
and finally, you have the contingency. This, as you'll note, I've just boxed off the time there, comes slightly later. You usually get this a couple of seconds later, so you get a little bit of time to assess the first information, and then you finally get the contingency on asset purchases. And this relates to inflation and the outlook if it becomes less favourable, and conditions become inconsistent with further sustained growth of the path of inflation, then the Governing Council stands ready to increase asset purchases in terms of size and or duration. So what this does is it not only have they already said that it's open-ended, that they could continue with the purchases indefinitely, effectively, but also that they could adjust the size and or duration, meaning that they could re-increase asset purchases at any one point. So again, the way the change in asset purchases happens is very crucial. Can they still increase size? Can they still increase duration? So it's how the asset purchases are referenced and what exactly they're saying that they could do in relation to their asset purchases. So that's the first key part of communication, the rate, and then the guidance on those specific areas, the asset purchase program, sequencing of rates, and then the contingency relating to asset purchases going forward.
In 3 years' time. That doesn't suggest 3 hikes over 3 years.
Okay, let's have a look at a standardized format for statements for the ECB. So this is their normal way of communicating. This is what you'd expect on most ECBs, as long as they have not changed monetary policy, in which case the format of the statement will come up slightly different. Generally, you'll see the first paragraph, Mario Draghi, or the head of the ECB at the time, will reiterate their decision on rates, on asset purchases, and any sequencing. It's in the second and third paragraph that you get their assessment of the economy, and this is where there is additional opportunities for a trade. So what you'll get is you'll get an outlook on the economy, and the focus here is on growth, inflation, and monetary accommodation.
Next up, you're then looking for
the key references are to underlying inflation and to monetary accommodation. So let's go and have a quick look at July 2017.
And this is what I mean about trying to find your access point.
What happened is, in the second paragraph, the ECB statement described continuing strength of the economic expansion, which has been broadening across sectors and regions. The risks to growth outlook are broadly balanced. So that's their assessment of the growth outlook. So there is always a phrase after or just before the growth outlook to explain whether it's broadly balanced, whether it is improving, whichever it may be. And it's the change from the previous statement that is the key here. Is this becoming a more hawkish slant or a more dovish slant? Next up, you're looking for reference to inflation. So headline inflation is dampened by weakness in energy prices. Moreover, measures of underlying inflation remain overall at subdued levels. That's the key area, is that underlying inflation and their reference to how it is progressing. So in July 2017, it was at subdued levels. And therefore, and this is where generally the relation to monetary accommodation comes in just after that inflation outlook. So therefore, a very substantial degree of monetary accommodation is still needed.
And so the 131.10 then becomes...
So that's very standardized where the ECB does things. You get the general change or technical issues, then followed by the information regarding the economy and how this is likely to affect monetary accommodation going forward.
You a passive continuation trade. So that's your third opportunity that you play in the passive trade as you break 10.
After the general explanation and general talk that you get from the ECB, if they want to signal that they are going to do something in coming meetings, the ECB tries very hard to be very transparent, tries very hard to make it very clear what they're about to do. They will often use certain phrases to tell you that at the next meeting something is likely to happen. What exactly that is, you don't know. But understanding expectations going into a meeting will give you a pretty decent clue as to what is likely to be coming if they transmit to you that they are likely to do something in the future. So the way that they've done this is they talk about preparatory work, and it follows a bit of sequence here, but they will often talk about preparatory work first. So in November 2014, this was prior to the beginning of QE,
as to how exactly this
ECB staff and relevant Eurosystem committees, ECB has tasked ECB staff and relevant Eurosystem committees with ensuring the timely preparation of further measures to be implemented if needed. So it's this tasking of committees and preparatory work that signals that perhaps sometime down the line we're going to get an indication of a further change in policy. The next meeting following that November meeting, December, they actually stated in the statement after the economic assessment that in this context, early next year, the Governing Council will reassess monetary stimulus achieved. Now, it's that reference to reassess or re-evaluate that is key. If they use that phrase, it is very likely that you're going to see something change in the next meeting. Now, how does this play out? It doesn't mean that you wait till the next meeting. The market will act right there and then. So picking up on these little phrases, these key words that pop up every so often, will give you a trade. And you know the direction. If we're moving towards a more dovish stance, i.e. greater stimulus, then the move is likely to be a dovish move. So a push higher in bonds and move higher in stocks. They go on to say they'll reassess monetary stimulus achieved, the expansion of the balance sheet and the outlook for price development. Will also evaluate oil prices, and should it become necessary to further address risk to long period of inflation, the Governing Council remains unanimous in its commitment to using additional unconventional instruments within its mandate. So basically they're saying that they're going to reassess next time, and if need be, they have got additional instruments that they could well use. So this is their way of communicating forward, trying to be transparent in what they're going to do going forward.
Any continuation? No. So what we've now got is a range that we're waiting to see the break of. Now, from a technical point of view, those shorts could well now have been viewed as being squeezed out, and we're then going to get...
So following on from that note on reassessing in December 2014, the ECB then delivers action. This is how it comes up in the statement when it's not a standard statement, when you get action. And note the format here. First paragraph. Based on regular economic and monetary analysis, we conducted a thorough reassessment. Usually the first paragraph starts by talking about interest rates, starts by talking about asset purchases that they're currently doing. The fact that they don't go down there and they go straight in with talking about their reassessment gives you an indication that they have done something, that they are about to change something. And then the next paragraph begins with first, and they will then list the things that they are going to change or implement going forward.
back up.
So it's all about how that changes in that first paragraph. As soon as you hear, based on our regular economic and monetary analysis we conducted, you know that it's not normal, that they are going to do something different, and you're going to hear about it in the coming paragraphs. So that's how that's communicated,
and we find some buying quickly.
all about the phrasing of those paragraphs. And this is the reaction that we got.
Don't break 19s. If we get
Bund surged on this news, and actually if you look at that total move, we saw around about a 200 tick up move in the Bund. This is a 1 minute chart, so it's a very, very strong move higher, a bit of a pullback followed by an equally strong move higher again, over the course of around about half an hour. So a very short time scale to get a very, very large move that is very sustained, because of the fact that they have come out and basically said that they are going to do asset purchases. But this all came from that preamble in November and December that gave you the clue that they were going to do something at the beginning of January.
Still a potential opportunity. Those who are long are still feeling they've got a little bit of comfort.
Final chance in the press conference for Draghi or the head of the central bank to get across any policy measures that they don't feel the market has absorbed properly is in the Q&A. This has often been used to either bring in new ideas or to reiterate points that the market's perhaps not taken on in the statement. So there'll be numerous questions for around about 45 minutes. And one of the questions here from 2017, did you have any preliminary discussion today, and did you discuss options for future of QE?
Take a bit of time before we get.
What Draghi comes out and says is that the Governing Council will ask for, or will want to see, work by committees that we've tasked to continue working, but also points out that rates will stay as they are at present levels. So he gets a chance to state that they are looking at doing more, the preparatory work, so potentially we know that something could be coming up in the following meetings, but also reiterates that it will not be in relation to rates. Next up, you then get a question, could you right now commit that we would know the decision about the future of the QE programme in October, or will it be delayed even further until a December meeting? Draghi goes on, and this is where he sort of pushes away certain questions as well. Governing Council reiterated it's this fall as a period when these decisions will be taken. So they often will use a vagueness to get around decisions. However, he then goes on to clarify and says probably the bulk of these decisions will be taken in October. Therefore, you know that come October, we are likely to get some news predominantly regarding the asset purchases, because he has already stated that rates will stay as they are at present levels for an extended period of time. So it's this question time where he can throw out a couple of little bits of extra information, or want to clarify or push the market towards focusing on a certain thing. The majority of questions, Draghi can be very forthright and say, no, this was not discussed, or say, no, I'm not answering that question. So he can just bat away questions. But if they want to get information across, it can often come across in the questions. Focus is key here. Questions can go on for 45 minutes, and you could end up with a lot of questions that are reasonably irrelevant or very country specific, depending upon where the question's being asked. It's the key questions that you want to be focusing on. As long as you're ready for that, then there is still a trade in the offing for you. All right, so we're going to have a look now at ECB sources and where the opportunities lie there. A major tool that the ECB uses in terms of communication is their sources. Now, theoretically, no one knows who these sources are. They're always unnamed sources, and whether that be a member of the Governing Council, a member of staff, no one knows. The point is you don't need to know who it is. The sources generally will give a bit of guidance going into any ECB meeting as to what could well be about to happen. It has also been postulated that these can be a sort of testing of the market to see what the market's reaction is to a certain change from the ECB. And so they can then decide whether it's warranted at this time, or whether to perhaps go against the sources and wait a little bit longer. But the big benefit of sources is they are totally ad hoc events. It is an interpretation trade, of course. But the key thing here is if you understand the direction the ECB is currently moving in, or the potential additional changes that could be made, this provides you with an opportunity. You can almost be ready for the sources. You can't ever know when they're going to come, but you can have an idea of what potential sources could come out and be ready for that and know a certain type of trade or what you'd expect the market to do if you get a certain type of sources. So this was back in April, and what people were starting to wonder, and this is April 2017, was could the ECB shift their policy message, so shift their forward guidance at the April meeting, guiding either rates or guiding the asset purchases going forward. Now, because of the fact that the ECB had already drawn back on purchases in December, any kind of shift in policy was likely to be a more hawkish slant. So with that in mind, if they say that ECB policymakers are wary of making fresh policy message shift in April, then the Bund takes a rather dovish move and we get a full, in this case, 65 tick move, and this took around about 4 minutes to play out. Now, with sources, one thing that is very worth remembering, initially and quite often you will get a first jump, and you can see this, the smaller green candle before the much larger couple. You get a quick jump and then a bit of a pullback, and this is where the market perhaps is waiting to see if there's any more sources. Also, for people who've not got the sources, it's a sudden jump out of nowhere, which generally will get faded back. So if you get the sources, interpret them, and you have to stick with the trade if you believe it is something that is fundamentally changing the picture for the ECB going forward. But as I say, frequently the ECB will put these sources out. I would suggest perhaps once a month you may get an opportunity on ECB sources. The severity or the scale of how much they move varies depending upon what the sources relate to. But they do provide ad hoc opportunities, and it's all about keeping up with where the ECB currently is and where their next move is likely to come. And that's what helped this April move. It was all about the fact that their next move was potentially going to be a more hawkish shift. This completely took that hawkish shift away, and you got a 60 tick move in the Bunds for it. We're now going to give you a practical look at trading ECB sources. Now, to give a bit of context, and this is always the key thing with sources, it's all about the context prior. The chart that you can see on the screen is a chart of a press conference given by Mario Draghi at an ECB economic conference in Sintra, which is in Portugal. Now, what seemed to happen is Draghi changed the way his wording of a few things. He used the general same format that he would use in a normal ECB statement. However, he put in a few different phrases. He suggested that all signs were pointing to a strengthening and broadening of recovery in the euro area. That was a pretty standard phrase and one that is generally used in their press conferences. However, the phrase that he did then use was deflationary forces have been replaced by reflationary. Now, the ECB's fear for a long time was of deflation and had not talked about reflation coming in or an increase in inflation in the euro area prior to this. So this appeared to the market to be very new information. This did coincide with a technical break as well. So if you have a look at where the arrow is on that chart, we've got a trend line break and the break of a low as well in the Bund. So from a technical point of view, this made sense for a fall. However, the comments that Draghi made added to the severity of that fall, and the Bund fell from 165.10 all the way down to 162.78. So a full 230 tick move based around these comments. Now, from the technical point of view again, if you look at the chart, the move down didn't have any pullbacks. It was very forced on the move down. And so what this is suggesting is that if the market does start to come back up, there's a lot of scope to take out a lot of those prices because of the fact there's no clear reference points that would offer you any resistance on the way back up. So a little bit of a technical context there as well for you. The market has then ranged for the next day, and that's what you can see in that bottom part where you get the up and down piece. That is the range from the following day. So that's setting you up to trade these sources. Now, as I said, with context being so key, the ECB has in the past, and this is where understanding the ECB in a little bit more depth, has often contradicted any comments that have caused a large market move. So this very large move in the Bund, there was always a thought or always a plan or discussion on the trading floor that they could potentially release sources that contradict the move from yesterday, i.e. dovish sources. This is always a possibility in the next couple of days and something that we are all very, very aware of and ready potentially to trade. Here we go then, a look at those sources. Now the ECB will often attempt to contradict any comments that have perhaps caused an outsized market move or what it perceives to be an outsized market move. Now the 230 ticks move the previous day in the Bund was a very large move, and so there was always potential that the ECB could release sources that contradicted Draghi's comments and therefore brought the market back up. So this was something we could be entirely ready for and was discussed on the trading floor that morning, that there could be something that basically said the market misinterpreted or some phrasing to that extent. So you could always be ready for it and you knew exactly what the trade was. Because we had that forced move lower, so very few reference points to stop out on the upside, there was a good possibility of the market surging very quickly if we did get any source comments. If you have a look at the chart, you can see exactly what happened. I'll explain those comments. Basically, the first comment was markets failed to take notes of caveats within Draghi's speech, and also that the comments intended to prepare markets for a decision on stimulus later this year without making firm commitment. So no firm commitment. What this is saying is that even though he's talking about reflation, this is not going to impact any of their monetary policy, at least until later on this year. Now, another little technical reference for you, and for when you're trading this, these are areas that I want you to note down or watch exactly what happens. You've got multiple single prints. For those of you who don't trade market profile, single prints, areas where you have one letter on the profile, tops of each are often seen as resistance areas or areas that the market could at least stop at to start with. So those single prints, when you're trading this, come in at 163.62, 82, and then the final single print, so the last single print, 164.03. Now, you can see what happened. This is a 1 minute chart, so an extremely fast move. So the whole idea of this exercise for you is not to get on the move necessarily, but that is what you're aiming to do. The point is to learn how the price action works. So does it slow down at each of those single prints, and does that offer you a way to get into the trade? Remember, you're unlikely, unless you happen to be looking right at your newsfeed at the time of the sources, you're unlikely to be in within the first few ticks. So where is it that you can get in? That's what you're looking at. And this is a chance for you to practice your debrief that we spoke about in the earlier part of the course. So go through it, have a look particularly at how it trades at certain areas, and also what is very typical on very fast moves is an opportunity for a reversal trade as well. So look out for what it is when we get to those highs that offers you the chance to reverse. Is it just the chance to sell at the high, or is there another point lower down that you can sell and see the market accelerate lower? So think about all of these things as you're trading it. The idea here is to get used to the price action, to get used to the speed with which it moves and how the market moves from very quick surges to slightly slower trade, and then quick surges again. So take note of those, become accustomed to it, and this will help you out for the drill that is coming up next. Okay, so when executing on a piece of news, so this is a surprise piece of news. It's not a piece of news that you could have expected at a certain time. This is a sources comment, comes out whenever it comes out in the middle of the day. But with any kind of news execution, there's still a process to go through. There's still a format and questions that you need to very quickly ask yourself. So the first thing you need to be considering is, what does this mean? In this instance, it's a sources comment. It's counter the move that we got the day before on Draghi's speech at Sintra, that then should begin to turn some of that move around. The next question is, how big a deal is it? In this instance, a pretty big deal. It's taking back some of what was said. When we go and look at the sources in a moment in a little bit more detail, you'll see how actually perhaps it's not that big a change. This then starts to help you decide how much size to trade. If it's a really big deal, then this is where you're looking for a full size trade and the opportunity to hold on to it. What you've also got to be asking yourself is, what is the scope of this move? Now, this is what makes this such a large move. The market doesn't have a great deal of resistance in it. All the way down from the recent highs, there's no major pullback. There's no area that you could say, yep, that's a resistance point. So that means that there's very little to stop it once the market starts trading back up. Going over to a profile, you've got the single prints, and so each set of single prints, as mentioned previously, is going to be an area to be looking for. So 60s, 82, 93, and then the final set of single prints inside value up at 164.03. So they're going to be the areas to be looking for. The other thing to be thinking about is the positioning from the morning's trade. Everyone's sitting in this tight range down at the low, so lots of new shorts trying to play for this move. So you've got an idea of whether it's a big deal, or you will be trying to answer that question very quickly and then think about the scope of the move as well. How far can this really go? As I said, up towards those single prints looks like a pretty decent area. So they're going to be the questions you were trying to answer very quickly. Now, this sounds like a lot to answer in an instant. But if you're trading this market through, just by trading that day, you're going to have a sense of where the market is, where it could start turning back to. You would have considered, if you start any move higher, whether these single prints fill. So you're going to have an idea of where those areas are. You're going to have an idea of the scope of what could come from this, because the fact you will have assessed the way the market's trading. So a lot of these answers will come straight to you because you're going to know how the market is currently set up. The other thing to take from this is that the ECB quite frequently will give a sources piece if the market, in their view, overreacts to any one comment, and in this situation this would be seen as a rather large overreaction of around 200 plus ticks. So that's in terms of the
what does it mean? Is it a big deal? And scope of the move. Next up, you've got to consider your execution, and your execution when you're onside. So what you've got to think about is, how do you get in? As soon as you get a piece of news like this, what you want to be trying to do is get one clip in. What you've got to ask yourself there then is, are you in early enough? Have you got in at the beginning of this move? If you have, then that's the chance to add more, and the speed with which you add really matters. The aim should be to get as much size in as possible early on. The longer you wait for it, the more you skew your average price higher and higher and higher up the move. This puts your skew in a bit of trouble, because it means that only a marginal pullback will be enough to start getting you out or start putting you offside on that position. So you want as much size in as fast as you can. If you're getting in later, then it's a situation where you don't add as much size. The other thing to be considering once you're in as well is, where do you scale out? Do you scale out each time it stalls, or do you have a major target or a larger target that you're going to be aiming for? In this situation, you'd be watching at every resistance, at every single print point, looking for whether the market has a little pullback from there or not. If it doesn't and it surges through, then that's another tick in the box of hold on to your position. The other thing to be thinking about as well is, where can you add on to this? Can you add on as the move keeps on going? Or is it a case that once you're in, if it moves a long way away from where you first got in, do you still want to be adding at significantly higher prices? That's all on the positive side of things. The other thing, equally as important though, what happens if this goes offside? What happens if you have misinterpreted the news and the market doesn't move in quite the way you expected? Well, this is what you've got to be thinking about very quickly, is if ever you hit a piece of news like this, a sources comment, an ad hoc piece of news, what you've got to be thinking about is cutting your risk back to something manageable if you go offside. What you don't want to be is sitting full size, going offside to a point that you're not comfortable with, but you feel you can't take that loss because you've got so much size on that trade. So the aim is to scale it back very quickly to an amount that you can manage. You can always add it back in, but what you don't want to be doing is carrying a large position a long way offside. The other thing to be thinking about as well is, once you've scaled back, make sure you're focusing on what the market's doing, not what the position is that you've got. If you're then starting to trade in a small range, and we've looked at this from a positive side of things as well, if you're starting to trade in a small range, what you can then do is use that range to add position and take it out, add and take it back out. That way you improve your average price and still give yourself the chance to get yourself out of that main position. So there's an opportunity to work a position a little bit here. These are the things you've got to consider when you have a news event like this. What does it mean? How big a deal is it? When in terms of your execution, once you're in, where are you going to get out? Do you scale out? Do you hold? And also the other really important question is, have you got in early enough? What you don't want to be doing is jumping in later on if you've already missed the move. We'll go and have a look at how this applies. First up, taking in the news. So as we saw before, the sources comments were that the market failed to take caveats of Draghi's speech, suggesting that the market basically has overreacted, and that the comments were intended to prepare markets for a decision later on in the year without making a commitment. So what that's suggesting is that people have overdone their reaction. They should be taking some of this back. And you get the move that stacks up exactly to that. So here's the move. What I'll do is I'll also replay the ladder so you can see the pace of this move here as well, and where you would want to be trying to get in, how it stalls at certain areas. So I'm thinking particularly around 60, around 80, and then also where that reversal opportunity is. As you get up there, of course you're not going to know this, but you're going to know the levels to be looking for, and then there's a very clear reversal opportunity looking from a ladder point of view. So let's go and have a quick play of this and we can see how the market reacts. We're trading currently 163.20, so inside the day's range. 163.36 is the key area. That gets you into the single prints. Here's the news. So as long as you can get in around here, 36 to 40, that's the area you'd want to be trying to get in. Getting in much later, and we've already now seen a 45 tick move within about 10 seconds. This is not then the area you would want to be adding significantly to your trade. But straight through 60s, your next target's going to be 82, the next set of single prints. And again, straight to it. This is a chance to scale out. But the fact that we're not dipping back down, and the fact that you're not moving back through the low volume that's established at 78 is a reason to then think we've got further to go on this move. We're now up towards 92, the bottom of value, and try to add on once more. Still holding these low volume areas, but as soon as that comes back, those adds you should be trying to take off. If you've been adding above 90, you don't want to be holding that and carrying that position back. So right now we've moved up 75 ticks in under a minute. This is now the point in time where you're starting to think, how much further can this go? What is the scope of this move? The last set of single prints comes in at 03s, and you can see this large order sitting up at the highs. That's a prime opportunity for a reversal. This has been an extremely fast move in a very short period of time. So if anyone's going to be taking profit, this is an area where people could well be looking to take profit, and this can create the reversal trade for you. What you're now looking for here is areas for this to fall back, and you've got a couple of very clear zones to be looking for. You've got the low volume down at 88s, there's your first target, and you've then got this low volume once more down at 79s and 77s. So they're going to be your targets on a reversal. Now remember, if this is a reversal, it's not necessarily just going to shoot back. Not often do you get a market trade up a full 80 plus ticks and then reverse in a dead straight line as soon as it hits a level. What's happening at the moment is people are buying. People are trying to get long for a continuation of this move higher, which is why we then find short-term support around about the 163.92, 93 area, which keeps the market testing up. If you've taken a short here though, you have got the security of the large order. You've got a large order at 06s. A stop beyond that gives you some safety. If you're short 03, it's a reasonably tight risk, and particularly if you're long all the way up to this, then it's a rather small risk to be taken back. So you see, once again, holds around the 97s, still holding around the 03s, and what you're waiting for then is a break through that 93 area. Then that's going to give you the further move down that gets you right the way back towards the 82s. Now, in terms of how you're going to manage this position, it could well be that you try and scale out just around the 93s, try to take a little bit out of the position as it starts to pull back. You can still add as it goes through 92, 93. You see here an attempt at adding at 95 to try and get a little bit more size in, still scale at the same position around 90s. But by adding at 95, where we have now started to fall back and we're stalling at 95, the market's not bouncing away from this as fast as it was originally. So now that we're stalling here, this is a chance then to get in a little bit more, still scale some at 90, but you then, what you scale at 90, you're still able to hold pretty much the same size you originally had, all the way down towards the mid 80s and even mid 70s. So you can see the amount of volume being done at 94, 95. This is where you're getting a battle. Some people are still trying to buy this for the continuation higher, even though we are 75 ticks higher than where this move originally started a few minutes earlier. Others trying to sell, using the liquidity of the buyers to try and get out of long positions, sell into those new buyers coming in here. So this is your tipping point. through 94 and we start to fall. If we can get back above 95, 96, 97, then the buyers are starting to win, and that then can progress the move higher, start getting the turnaround and the continuation right the way back into the previous day. Starting that dip down, now trading 92, 91, starting to get out of the position here. Remember, this is a reversal trade. You're just trying to take a bit extra out of the move as people start to profit take. We get down to that first area of low volume around 88, 89, but still, even when you get a bit of buying from there, the sellers come straight back in very quick. This is what you're looking for if you're already short. If you're playing that reversal, and if you're trying to get in, selling around 90 now would be the place to try and sell. You're then looking for a move down through the mid-80s, down into the mid-70s to get you out of this reversal trade. It's not a trade that you're necessarily going to try and hold for the entire move back, and more a trade that you're looking just to play back into the mid-70s. This is an opportunity to take an extra 20 ticks out of the trade from what was a very, very safe entry, because you had that size that offered you that very tight stop. That down in towards the high 60s, that's back onto those old single prints and decent area to be exiting your trade. So that's the way you'd be looking at trying to trade these sources. Now, they're not always going to come out exactly the same, but the key takeaways from this were the very fast move up and making sure that you've got in early. As long as you were in before we broke the highs of the current day, so before 163.36, that's where you could be looking to try and add the most size. You're then looking for the move all the way through those single prints as well. Because of that very, very poor structure on the way down, there was no clear resistances. So the only things you've got are the single prints on the way back up. Each one of those could well offer you a bit of resistance, but as soon as it pushes through each one, you'll then straight away look into the next single print for your next target. So you first had the move through 60s, then through 80s, up toward 90, and that was where you got the first pullback around 90 to 80. Once more though, onwards all the way up towards 03s, and then you got, this is something to take from the price ladder rather than anything technical, but you've got that large order resting there waiting to get filled. This provides good protection if you want to have a go at front running. One, to get out of your long position if you're in on that original sources comment, but two, it provides you a rather cheap stop for a short position. Remember, there's going to be a lot of other people long here thinking to themselves, yes, we're going to get a big move. As soon as they see that large order, they're then going to start profit taking. So what you're doing is you're taking money as people start to profit take, as people realize that the move isn't going any higher, as they start to sell 02, 01, 00, 99 to try and make sure they bank their profit. You're then capitalizing on that by entering that short position, looking for that shorter term reversal. Once you then consolidate above 93, that offers you the next area where either we're going to hold 93 and keep the move going, or alternatively 93 breaks and the move then reverses right the way back down towards those old reference points. So numerous trades to be taken there, and this is a slightly different scenario of a more news execution rather than a trade that has a distinct time that could have been played on, like any other central bank decision. This is not going to come at a specific time of day. It will come ad hoc during the day, and so you then have to react quick to it, but you need to have that process in mind of how exactly you're going to react. That way you don't hesitate, and that way you know exactly what you're going to do once you've got that position. So make sure you review those execution points in terms of how far it can go. Have you got in at the right point in time? Where do you scale? Cutting your risk back as well. If it's not going your way straight away, don't sit there with a large position that you're going to be uncomfortable if that starts to then go offside. Bear these things in mind for the trading drill which is coming up, and good luck with that. Okay guys, for this drill, what we're going to be looking at is a binary trade and a specified binary trade. Now neither of them in fact have anything to do with the actual rate, both focus around language, and we'll come on to what exactly we're looking at there in a moment. So this is the ECB. Now by this point, beginning of 2019, the ECB has wound down its QE, so there's no more asset purchases. The previous meeting, being January, gave very little in terms of information on the statement. Because we have no asset purchases and no guidance on them, the ECB has very little in its actual statement, so it's down to a couple of key lines. Obviously, to start with, you get the interest rates, then you get their guidance on interest rates. Their guidance being the interest rates will remain at their present levels at least through the summer of 2019, and that's the key bit, is the guidance on when the interest rates will start to rise, and in any case as long as necessary. The second phrase that the ECB is using now is that the Governing Council intends to continue reinvesting in full principal payments from maturing securities purchased on the asset programme for an extended period of time, past the date when it starts raising interest rates. So the two are linked. What this means is that until they raise interest rates, they will continue to reinvest any money that comes due to them from the bonds that they have already purchased. So as a bond matures, they are then going to reinvest that money. So that was the previous meeting. Going on to the March meeting, we'll go and have a little look at where the expectations were lying, also in terms of sources that had come up. Now going into the March meeting in 2019, things had started to get a little bit more turbulent in global markets. The Fed had already decided that it was no more interest rate raises to be putting in place, and so was then stepping back there. The ECB has yet to actually make any further decision on any forward guidance, and they seemed reasonably set that they would maintain their guidance of rates will rise at some point beyond summer 2019. We then get a few sources comments. First up, that the ECB has time to change rate guidance and that a TLTRO is seen as a priority. The ECB, in light of downside risks becoming more apparent, has now, through other channels, started to suggest that they could implement a TLTRO, a targeted long-term repurchase operation. This then is a way of giving more liquidity to the market without reinstituting QE. So the sources then go on to say that some policymakers hesitant to change interest rate guidance as it would impact the term of the next president. As we know, Mario Draghi leaves the ECB in October 2019. Now, the idea here is that they're suggesting they won't change that summer 2019 language, because this would then push it beyond Draghi leaving and mean that it would now be the next president already forced into a position where they have to follow up on the language that's been changed. Further sources then start coming out that the ECB is to cut growth forecasts, and that it could actually have a discussion of whether it would change the through the summer guidance on interest rates. The announcements of TLTROs are not likely to come in March either. So sources sort of suggesting that some of these certainly putting into play the idea of rate guidance changing and a TLTRO, but neither of which are actually expected to happen at the March meeting. So in terms of expectations, what we have here is no change in policy or language, potentially a new TLTRO, and then in terms of further guidance, perhaps in the statement we may well get a downgrade of forecasts because GDP had been falling, also a downgrade of inflation guidance, so to suggest that inflation may be subdued for a longer period of time. This would come more in the statement. In terms of market pricing, the first rate hike is now being pushed into 2020, so beyond where the ECB is suggesting that the first rate hike would start to take place. Only marginally since the January meeting, so it's slightly moving excuse me, those rate expectations out, but not by a great deal. So that's the expectations. What we then got the day before the ECB was one final sources comment. This suggesting that the ECB would cut the outlook and in doing so, this would then warrant implementing TLTROs. And so it would then actually start holding discussions on these, so that they would likely come in March, and then further discussions would be had. Now look at the reaction of the BTP compared to the Bund. The BTP is the one that's set to benefit the most from this. Italian bonds are more under pressure than Bunds. Italian banks need liquidity more than German banks as well. So for that reason, the BTP is the one that is going to have the larger and more prolonged move. The Bund, and this is very, very important for actually trading the decision, moves up on the initial suggestion of a TLTRO and falls all the way back to the scene of the crime, SOC, on the chart. After it then starts to stabilise, then the Bund starts to follow the BTPs up, whereas the BTP continues the move straight from the beginning, jumps up and then continues on from there. That's key information, particularly when it comes to actually trading the ECB decision. So that's the source's reactions. It now seems relatively clear that a TLTRO is likely, and the really, really important bit is going to be whether they do actually change the language regarding that summer 2019 guidance on interest rates. So let's go and have a look at the actual trade opportunities, and this is what you're going to be looking for when you're doing the drill, when you're actually trading this ECB. First up, you've got the TLTRO. Because this has been so well talked about from sources, both prior to and the day before, it now seems that there's a trade either way. So this is quite a binary trade here, and like I say, this is a binary trade based on language. If they bring in a new TLTRO, this is going to be a buy. It's going to be seen as dovish, so it's going to be a buy for bonds, it's going to be a sell for the euro. In taking this trade on, because it is reasonably well expected, particularly following those sources, it's perhaps more a smash and grab trade, that you get in, you take the first move and you get out. If you are looking to hold anything, BTP is perhaps the one to hold. Now if they don't implement a TLTRO, this is where you're going to have a sell the bonds, so sell the Bund, sell the BTP. Because the BTP rallied so much the day before, that would be the one that you'd want to hold on to. The euro would still be the same principle as the new TLTRO and be very much a smash and grab, but with no TLTRO you'd see a bit of relief and the euro bouncing to the upside. So short term, quick trade to be had on that TLTRO. Where the bigger and perhaps more prolonged trade, the trade where you can hit and hold, is the extending the rate guidance beyond summer 2019. Any suggestion, and this is why it's a specified binary trade, because there are multiple outcomes, all of which would mean the same thing. Any suggestion that they could extend or that they would keep rates at their present levels through the end of 2019 into spring 2020 through summer 2020, anything along those lines would be seen as very, very dovish. It's a shift in when they're actually going to change interest rates. For this would be very much a buy bonds. It would also be a buy in equities because of the interest rate element, and a sell in euro. All of which you would be looking in initially, at least for the first sort of half an hour, to be very much a hit and hold that trade. Even if it does pull back, you're still likely to see this move continue. Remember what I said about that Bund on that TLTRO sources comment as well, that initially it jumps up, pulls back, holds, and then goes again, so keep that in mind. The only other element that we get in the first statement is the reinvestments, and whether they give us any clue on what an extended period of time is. At the moment, the market seems to believe that this is 2 years, so that they will continue reinvestment for 2 years beyond the first interest rate rise. If they clarify this, so if you get anything on reinvestments that suggest that they would reinvest for 2 years after the first rate hike, then this would be seen as very dovish. If it's less than 2 years after the first rate hike, then this would be seen as much more hawkish. It would be a sell the Bund, buy the euro situation. Finally, a big surprise would be if they downgraded confidence in inflation in the 1245 statement, and that's what you're going to be trading. So if we did see that come in, that would very much be a buy Bund. It would also be a sell euro trade. But the main bits that you're looking for is that binary trade on the Teltro and then your specified binary trade on the rate guidance, whether they change it or not. Any change that goes further than summer 2019 would be seen as particularly dovish. Right, so let's go and have a quick look around the markets and a look at where these markets can be going. First up, I've got BTPs. Now, you won't be trading BTPs, but when we have a look at how this was traded, we can see how the BTPs reacted. BTP has rallied on those earlier comments from the sources the prior day and left a close up at around about the 128.55s area. Very, very little on the way down in BTPs until you start getting down towards 127.70s, 127.50s area. So fair bit of space in BTPs. Further on in BTPs, 128.73, and then finally 129.22 for the high volume, much higher up. Now, the markets that you are going to be trading. Bund first up. In terms of areas to be looking for in the Bund, to the upside, you've got the beginning of this drop that we've had from a week or so prior to the meeting. That starts off at 163.92s. Further on from that though, you've then got the poor highs. You see the multiple highs in that box there. These begin at 164.05 and extend all the way up to 164.15. So that would be your bigger target to the upside if you're taking any trade long in the Bund. Remember, it's more likely to be a bigger move to the upside because if there is something to give this market a move up, it's likely to be a change in the rate guidance. That's going to drive a bigger move up. Whereas a move down would be a no Teltro and no change in rate guidance. We're not expecting rate guidance to move, and no Teltro would be perhaps a little bit of a shorter term dip. So you'd be looking more down towards 163.51 down to 45, 31s, and then finally 12s. Now 12s would be quite a long way down to get that just purely on the back of no Teltro. So that would be something more of a surprise. Any move down is perhaps more a move that could be faded as opposed to continue to try and sell. It will be more of a short term smash and grab if they do not do a Teltro. Moving on to the euro, and what I've got here is a daily and an hourly chart. Now levels to the upside in the euro, first place, nice and easy, just above 113.35, so that's the top of the recent small range that we're in. Beyond that, you're then looking up towards 113.55 to 60s, and then all the way up towards 113.67s, which brings in these lows over here. Now to the downside, we run out of levels reasonably quickly on the hourly chart. You've got 113.07, the most recent or very recent swing, and then beyond that you're looking down as far as 112.95. Past there, you're then getting onto the daily chart, and your next levels coming up are 112.60 and then finally 112.49. So the two lows on that daily chart. So that's what you got for the euro. These charts will be visible as you start to do the exercise as well. Read through the cheat sheet before starting, but what we are looking at, I've got the trades set out there as well. The Teltro, bringing in a new Teltro, the dovish trade, obviously you have the flip of that if they do not bring in a new Teltro. Any change to language is going to be crucial. Any extension to summer 2019. So if they suggest that rates will stay at their present levels through spring 2020, for example, through the end of 2019, that will be seen as very dovish. If it's unchanged, there isn't really a trade on it because that is the expectation. Finally, you've got the forecasts, but again, these are likely to come much later. It would be a surprise if they come in. If they do, and they come into the 12.45 statement and are lower, then this is going to be a buy the Bund and sell the euro if they've all come in lower. But this is much more likely to come as part of the statement. So the Teltros are your binary trade and are more of a smash and grab trade. The language change is going to be much more of a hit and hold type trade. Now, if it is a language change and it is dovish, it is going to be more that you're looking to buy the bund, sell the euro, and try and hold on. So, the drill. Have another read through the cheat sheet. Make sure you familiarise yourself with that. Familiarise yourself with the charts. Set your replay up for 12:44 on the 7th of March 2019. Trade this for 30 minutes. Trade the bund, which is FGBL9, FGBLM9, and the euro 6EH9. Also, start the attached video the ECB released when the replay hits 12:44 and 30 seconds. This will then give you a real-time release in time with the replay, so as you would see it if trading the real market. After you've traded that, start the quiz. You'll be able to complete this, and then there will be an answer and run through to follow, where we will look at the bund, the euro, the BTP, and maybe a little look at the equity markets as well. Good luck with the drill, guys. Good luck with the quiz, and I'll see you for the rundown afterwards.